glad to host you again. I hope you guys have an amazing session here. Firstly, I would like to introduce you to all of you to Suraj Lakhotia. So, Suraj is basically the co-founder of IndigoLearn, which is an edtech firm, edtech company which helps students across the world with accounting and finance and prepares them for accounting courses such as CA, CPA, and CFA. And Suraj, he himself was an AIR two in his CA finals, and he's been a constant All India ranker in CA. He's also SEMA UK qualified. He currently trains CPA US, CMA US, and SEMA UK students, and he's also associated with ICAI for creating new content and new case studies for the CA new course for CA final. So we have a great educator here today with us, who will be teaching you guys on Ind AS. So I'll request all of you to access the handout. I've made it all public. So the PPT is there. There's an introduction of Indigo Learn also that you guys can, download and understand what Suraj is doing, and it's great for our CA industry to see startups and co-founders like him who can help us achieve. And we as chartered accountants are generally said to be the on the back end who are just doing the number crunching work, and I'm pretty happy and glad to see someone up there doing the whole startup and everything there from our field. So Suraj, welcome to our platform. Thank you for coming in. um, and yeah, so Suraj, you can start with us, start the presentation right now. Uh, just a second. I think I'll just check where Suraj is. Yeah, yeah, Suraj. I think you can take it from here and start the presentation.
Sure. Thanks a lot, Sakshi, and thanks for the presentation, and thanks a lot for the opportunity of sharing whatever I can share in the span of the next 1 hour. Welcome everyone. Welcome to this session on leases. I'll just share my screen so that we can right access what I'll be talking about. I'm not able to share the screen. Sakshi, if you can help me.
I think, can we do the PPT presentation from here itself? I mean, till the time you were able to fix the screen issue.
Sure.
Yeah, okay. So everyone, I think Suraj is going to start the presentation in a couple of moments. Um, he's just figuring out his presentation. Meanwhile, I would also tell you, so Masters India has launched a new app, which is the GST Analyst app, which helps you track all your GST related data for if you're a business holder, or you're handling business SMBs as your clients. I would request all of you to download the app and understand the interface and provide us a feedback. I've dropped the app link in the comments in the chat section. I'll be sharing a couple of. You can check out the app promo till the time.
मास्टर्स इंडिया ऐप के जरिए आसानी से देखें अपना बिजनेस डेटा और लें बेहतर बिजनेस डिसीजंस। मास्टर्स इंडिया ऐप के साथ अपनी सप्लायर की रिटर्न फाइलिंग ट्रैक करें और अपना जीएसटी क्रेडिट लॉस होने से बचाएं। जाने अपने सबसे बेस्ट परफॉर्मिंग प्रोडक्ट्स महीने, तिमाही और साल के हिसाब से अपने टॉप कस्टमर्स और सप्लायर्स को ट्रैक करें कंपेयर करें सेल्स और परचेज डेटा रीजन वाइज, देखें कस्टमर और सप्लायर खाता और शेयर करें व्हाट्सएप या ईमेल पे पेमेंट के लिए। जानिए अपनी जीएसटी लायबिलिटी हर महीने बेहतर कैश फ्लो मैनेजमेंट के लिए। यदि आप एक सीए या अकाउंटेंट हैं तो शेयर करें बिजनेस रिपोर्ट्स अपने ग्राहकों के साथ और दें बेहतर सर्विसेज। यही नहीं, मास्टर्स इंडिया ऐप के साथ पाएं अनेक रोमांचक सुविधाएं और लाभ। तो देरी कैसी, डाउनलोड करें मास्टर्स इंडिया आज ही गूगल प्ले स्टोर या ऐप स्टोर से और डेटा के उपयोग से बेहतर बिजनेस डिसीजन।
Okay, so I think you guys have had an idea about what the app is. Request you all to download the app and provide us a feedback if possible. Suraj, can you share the screen now and start with your presentation?
I think there's some issue. I've shifted my system, so I'll continue with the presentation hosted on the demo link itself. I'll take it from there. I hope that works.
Great.
Yeah. Thanks.
Yeah, definitely. Ashwini, just let me know if there's an echo to voice still or it's resolved right now. I think it was a video problem back then.
Is it
just give a heads up. Yes, it's right now. Suraj, you can begin your session.
Sure. Thanks
I'll
a
answer
lot.
a couple of calls that I'm getting for the presentation.
Okay, sure.
Hello.
So now, welcome guys. Welcome to the session on Ind AS 116, which talks about leases. Now, if I have to, give a very layman term for lease, the term which we use.
Just let me do one thing. I'll share the. You're able to join? Okay, thank you so much. Okay.
I think, can you mute the participants so that there's no disturbance? Yeah. So, in a layman term, if I have to talk about leases, what we call on a day-to-day basis as rent, right? We would have encountered this on a daily basis. There is an owner of
I just set up with the
So, okay, coming back, I hope the audio is on now, right? There was some connection issue, so it got disconnected. So if I have to talk in a layman term, we come across this rental thing on a day-to-day basis, right? There is an owner of a property, then the person gives it out on rent to somebody to use it, right? So that person, what we refer to generally as a tenant. Now the tenant doesn't get any ownership right. What the tenant gets is right to use this property, and after a specified period of time, the property is given back or it is handed back to the original owner. This is what we understand on a day-to-day basis as a rent transaction. We also refer to this as a lease transaction. Now, this is a very simple transaction. I have taken something on rent for which I am making a periodic payment. And if I have to talk in terms of, accounting terms, for the owner would make periodic income in terms of rental income. So for him, the accounting entry would be a simple debit receivable or debit the bank account and credit the income account. For the tenant, again, it is a very simple entry like rent expenses and credit bank. Yeah, you debit expenses, credit bank, simple accounting entry. But then what was the need to have such an elaborate standard on leases? This is by far one of the most complex standard if you have to look at it from a practical application point of view. What was the need? When the transaction appears very simple, as if someone has given their asset out on lease or out on rent, why do we need a complex standard to take care of these kind of transactions? Now for this, we need to take one example so that we can appreciate why a simple looking transaction looks so complicated when it comes to leases or when it comes to lease accounting, right? So I'm giving out two scenarios of an airline company, right? And why in each of these scenarios, the transactions can be structured in some specific way to the advantage of the company. So in scenario one, let us assume there is one airline company and it wants to buy aircraft. Those aircraft are worth 100 crores, for example. And to purchase those aircraft, the company doesn't have any money. So what it does is it goes to a bank, it takes some loan, and with that loan, it purchases aircraft worth 100 crores. So if you look at scenario one carefully, there is a loan transaction and there is a purchase transaction. On the liabilities side, you can see loan. On the asset side, you can see aircraft. Now, any person who is reading this financial statement, they can make out that this particular company has huge liabilities. It has purchased almost all the aircrafts on loan, and there is a lot of commitment on the part of this company to repay those loans, right? This is the first scenario. Now look at the second scenario, and this was assuming that there was no Ind AS 116 or there was no standard on lease accounting. In the second scenario, what the other airline company does is similar operations, similar size, similar operating profits and all. What the second company does is instead of taking a loan, it directly approaches, let's say Boeing, right, the company which manufactures aircraft, and it gets into a deal with Boeing and says that we will pay you, aircraft, whatever is the cost of aircraft, we'll convert it into kind of an EMI transaction. We'll call it rent. You give your aircrafts on rent to us. Every month or every quarter or every year, we'll make out the rental payments to you, right? How long will we make the rental payments? We'll make the rental payments for 25 years. Assume that 25 years is the life of the aircraft. Okay. Now, in the second scenario, what happened is the second company smartly removed all the loan from its balance sheet and removed all the assets because it is taking something on rent. And this, the second scenario, what I'm talking about is assuming that the accounting standard on leases is not applicable before the leases standard, right? So in the second scenario, every month or every period, airline company will book some expenses and it will pay the rent to the airline company. Now, the problem with second scenario is if you look at the balance sheet, you will not get to know that this particular company has payment commitments for the next 25 years, right? Because by looking at the balance sheet, there are no liabilities, there are no assets, and you feel that this company is making a lot of profit. You look at the debt equity ratio, it looks very good. You look at return on assets, it looks very good. So this, in the second scenario, what this company has done is it has shifted its assets and liabilities outside the balance sheet. We call it off the balance sheet transactions. In the first scenario, just by looking at the balance sheet, you can make out that this company has a lot of loan to repay. But in the second scenario, you will not get to know about that. So to avoid these situations where companies could fool the investors, we had accounting standards on leases. From time to time, there has been a lot of changes, a lot of amendments. And the latest one being Ind AS 116, which got applicable a couple of years back, which is one of the most important changes in lease accounting, where any kind of leases that a company enters into, it has to be brought onto the balance sheet. We'll understand how does that happen. So to avoid the scenario 2 kind of situations where companies can easily shift their assets and liabilities outside the balance sheet, we have this standard on leases, which requires that even though you have taken something on lease, even though it is kind of a rental transaction where you are not the owner, but still you have to ensure that you bring on the assets as well as the liabilities on the balance sheet. We call it making the balance sheet heavy and disclosing the fairest possible view of the business to the shareholders or the investors, right? Now, this lies on the principle of substance over legal form. Now, if you look at these two scenarios, in the second scenario also, the airline company is using the same asset for a period of 25 years as if they were the owners, right? So why not show it on the balance sheet rather than showing it off the balance sheet. Okay, so with this we come to the definition of lease as given by Ind AS 116. What is a lease, right? I just gave a very broad reference that it is kind of a rental transaction. In a very in a layman term, in a common language, it's a rental transaction. But if you look at the definition, a very small but very powerful definition, I would say, a lease is a contract or part of a contract. So it's a contract that conveys the right to use an asset. So you remember house example where the tenant has the right to use the asset. Similarly, any contract which conveys the right to use an asset for a period of time in exchange for consideration. So the things that are important are, there is a right to use an asset, then it is for a specified period of time, and there is a consideration in exchange. If these three conditions are satisfied, then we call it a lease. Okay, now everything may not get covered under Ind AS 116, so we'll understand what are those transactions which will qualify for accounting as leases under 116. The party which owns the asset is the and gives it out on lease is the lessor, and the other party is the lessee. The party which gives the asset on lease or for use by the lessee is the lessor, and the other party is the lessee. Now the recent changes in Ind AS 116 impacts lessee the most. So what this change has done is, any kind of lease except if it's a short-term lease or of a small value lease, any kind of lease has to be shown on the face of the balance sheet. You cannot keep it off the balance sheet, right? So that is one of the significant changes in the recent Ind AS which got launched. So now, Sakshi, just to understand, if users have to ask doubt, can they ask in between, or do we have a doubt session towards the end?
The webinar. Yeah. Or you
Oh,
could
sure,
also
sure.
ask a
That
couple of
makes
questions
sense.
to the attendees if you want to make it a variable.
Sure.
Yeah,
So when I come to the, I
yeah.
think the illustration part, there is what. Oh, thanks. So now, this is a simple definition of lease, but not everything gets covered as lease in this particular standard. So what are those contracts or what are those transactions which qualify for lease accounting under this standard? So for that, we need to identify whether a contract contains a lease. We need to identify whether a contract contains a lease. Now, please note an important aspect. It has to be a contract. Okay, there has to be two parties, and there must be a contract between these two parties. Only then it will qualify as a lease. So if a contract conveys the right to control the use of an identified asset for a period of time for consideration. So we have understood period of time and consideration. The next important aspect is right to control the use of identified asset. So the lessee or the user must have a right to control the use of an identified asset, which means if I am taking something on lease, I must be able to control what? Control the use of an identified asset. So these are the things which we need to understand. What is the meaning of right to control, and what is the meaning of use of an identified asset, right? Let me ask you a simple question. All of you have mobile phones, all of you have internet connection, right? What do? You use those internet connection or those fiber lines or cable lines, whatever lines you use those lines for getting internet service, which means you are using an asset. You are using an asset of a telecom company, and every month you pay rentals, correct? Every month you pay rentals to the telecom company, and you get to use their internet service. Or you may be using some cloud services. You have this OneDrive, you have Google Drive, right? You may be paying, some of you may be paying the companies, some of you may be using the free version. Assume you are paying to use some storage space on OneDrive. You are paying to use storage space on OneDrive. What are you doing? You are using an asset, correct? And you are using it for a period of time and for consideration. Now, can we call it a lease? Now my question to you is, can we say that it is an identified asset that you are using? So if you guys can respond, if any one of you can want to respond, can we say that it is an identified asset? With whatever knowledge you have, it need not be correct, it may be right or it may be wrong, but that understanding is important, because identified asset is an essence of the transaction on the leases. Anybody?
Suraj, you can access the chat box. Most of them are replying on chat boxes. Yeah, so
Oh,
most
okay,
of them
I
are
understand.
answering no right now due to no contract, Kajal says.
Yeah. So there is a contract, okay, by the way, if you whenever you sign that application form and get an internet connection, you are actually entering into a contract, or that small checkbox, I agree to all the terms and conditions, that you are actually entering into a contract. But the question here is, it is not an identified asset. So when we say identified asset, it means you must be able to clearly specify or identify that, yes, this is the asset that I am using. Now, when I say that you are using storage space on OneDrive, can you identify which is the server? We cannot identify. It is up to Microsoft as to which server will they provide for my storage. So the asset is not identified, and hence it will not be a lease under the purview of Ind AS 116. Similarly, the telecom services that you use, you do not know which tower will you be using, right? And the service provider has all the right to change the the asset that they are providing for your usage, correct? You cannot control which storage server will you be using, and hence it is not an identified asset. But compare this with another example. Let us say you take a premise on lease, you take an office premise on lease. Can the lessor or can the owner of the property come and keep on changing the premise that you are using? He will not be able to do, right? Because you would have set up your office there. So there the asset is identified. The asset is identified. In this case, in the example that I mentioned, the asset is not identified. So this is one clear thing you need to understand whenever you are accounting for leases. Can you identify the asset? It may be a specified asset, a particular building. It may be identified by some description. It may be a customized asset made specifically for the customer. In that case also it will be identified. So if the contract gives the right to control the use, now this is another important thing. Once I have taken a premise on rent, it is up to me as to how do I run my business, how do I use that particular premise. If I take a machinery on lease, it is up to me as to how do I use the message. Obviously within the terms and conditions of the contract, but the economic benefit that I derive, I have the right to control. Now I was giving an example of these airline companies taking aircraft on leases. Even there, the airline company which has taken the aircraft on leases, they can decide, yes, I will fly from this route to this particular route, I will charge so much from the passenger. So right to control is given to the user. Only then you will call it an we will call that the contract contains a lease. So when we say right to control use, there are two things that needs to be understood. Number one, substantially all of the economic benefits from the asset use are obtained by the user. So if let us say Indigo Airlines has taken 100 aircrafts on these, they will be able to get substantially all of the economic benefits. Okay, some benefits may go back to the original airline company or original aircraft manufacturer, but most of the benefits should come to the airline company or Indigo Airline, and they have the right to direct the use of the asset over the lease term. For example, they want to fly on a specific route, so they should have the control. The user should have the control. The lessee should have the control. Only then we'll call that the contract has a lease, right? So now here is a case study again which you can try out. So in the internet facility example, there is no definite period of time, but there is no lease as well, because their asset is not identified. So there is no lease contract. So there is an electronic data storage provider which provides services through a centralized data center that involves the use of a specified server number 9. Now in this case, we are specifically mentioning that server number 9 will be used. The supplier maintains many identical servers in a single accessible location and determines that it is permitted to and can easily substitute another server without the customer's consent through the period of use. Again here, server has been identified, but lessor is deciding whether he can change the particular server. So in that case also, it will not be an identified asset because you are not controlling. Lessor is controlling what can be done with that particular asset. Okay, so there are two things possible. If the supplier, now I'm adding two more scenarios to this. If the supplier is obliged to replace an alternative asset due to operational failure, now this is a specific case. If the supplier is changing that particular asset due to operational reasons, then we can call that the asset is identified. Okay. If the supplier has to upgrade the asset because of technological changes, now these are very small things. Okay, these are very smaller aspects, repairs and maintenance, periodic updates and all of that, that can be done. But if the supplier can at their own will keep on changing whatever asset they have provided, in that case, it will not be an identified asset. Now, to give you a very real life practical example, let us assume that there is a complex which has ground floor and first floor. It has ground floor and first floor. Now, if the lease contract allows the lessor to move the tenant from ground floor to first floor to their advantage, let us say you have been given ground floor. Currently, you are paying a rent of 30,000. There is a new tenant or new person which approaches the lessor and tells that I will pay you 35,000. You please move this person to first floor. Okay. Now, if the lessor can do such kind of things, if the lessor can control such things, then it is not an identified asset. Okay. So, such right of substitution should not be with the lessor. Only then we call it an identified asset. Okay. So, these are the things we need to understand. Does the lessor have substantive substitution rights? Meaning to say, can the lessor substitute the assets at their own will? Okay. So, if the supplier has practical ability to substitute assets and they would benefit economically by exercising the right to substitute throughout the lease period, in that case, the lessor has substantive substitution right and that asset will not be identified. Okay. You will not call it a lease contract in that case. But if the supplier doesn't have substantive substitution right, then it will be a lease transaction. For example, you have taken a premise on rent and the lessor cannot move you out of that particular place, then that particular contract will be considered as a lease contract. And all the accounting aspects of lease would be applicable to that particular contract. But if you are substituting for repairs and maintenance, say for example, you took a Maruti, let us say Suzuki on rent or on lease, right? Due to some problem with Maruti, that particular Swift, the supplier or the lessor has given you a replacement car. That is allowed. That to that extent it can be done. But if it is like, instead of Desire, they can give you Baleno, they can give you Alto, they can give you any car, then in that case, you do not have control over that particular asset and hence it will not be called a lease. That is why car rental agreements are generally not covered under lease because the vendor or the supplier of that car services can provide any kind of car. Okay, but if it is very clear, this car, this model, this number, only this car will be provided, then it will be called a lease. This distinction is important because if you come back to our definition, a lease is a contract or a part of contract that conveys the right to use an asset. So almost everything would be covered in this. Then comes the question whether the asset is identified, whether the lessor has substantive substitution right. That is when you will start making distinction and identifying, yes, these contracts are leases and these contracts are not leases. Otherwise, your accounting will be very, very cumbersome. Okay, so it's important at the inception of any contract that you identify whether a particular transaction has, lease component or not. If at all a transaction has non-lease component or within the lease transaction there are non-lease components. For example, you have taken a premise on rent. Okay, along with that rental thing, you have to pay periodic maintenance. Now, payment of maintenance is not a lease contract. Payment of maintenance is not a lease contract, and hence you will separate it. You will call it as a non-lease component, and you will be accounting for it separately. Is using software and paying monthly charges will fall under lease. Now there you are using a subscription service. It's a software as a service. Okay, you just have the right to use as per the supplier's the service provider or software service provider contractual terms, right? You have very little to control there. Okay, you can just use, and since it is a monthly subscription thing, you will not categorize it as a part of lease contracts. Now that we have understood lease contracts, we need to understand how do we account for leases. Okay, so before that I'll just
every attendee to just ask a couple of questions if they have any questions regarding what is lease, and we can take your questions here before he starts accounting for leases. Yeah.
yeah, I
Anyone
think
who
that would be
has
helpful.
any particular question as to till the concept he's taught us? Hmm, I don't think there are any questions right now. You can carry on, Suraj. In case, guys, if you have any questions, just drop it in the chat
Yeah,
box,
okay,
and we'll be taking it up one by one. You can carry on, Suraj.
sure. Okay, so now I've just jumped a few slides further. I'll come back to the earlier slides again. Earlier, there was a huge thing around finance lease and operating lease. Okay, so there were certain contracts which were finance lease, and there were certain contracts which were classified as operating lease. And based on which category does the particular contract fall into, we would do the accounting. And finance leases were the ones which would be shown on the balance sheet. Operating leases were off balance sheet. Operating leases were not put onto the balance sheet, right? Now what happened was, because there was a choice, right? If it is a finance lease, I'll put it on the balance sheet, and if it is an operating lease, I'll not put it on the balance sheet. Because of these choices, a lot of entities, what they started doing was they started structuring their leases as if everything was an operating lease, so that they don't have to bring it onto the balance sheet. Okay, to avoid this, we have this significant change when Ind AS 116 was introduced, that whether it is a finance lease or an operating lease, the lessee has to bring them onto the financial statements. They have to recognize it in the balance sheet. So lessee no longer has any choice to keep some leases outside the balance sheet, except when it is a short-term lease or small value lease. All the leases have to be brought onto the balance sheet. This is one significant change which has made the balance sheet heavy. But still, from the lessor's perspective, you need to decide whether a particular lease is an operating lease or a finance lease, right? So when we talk about operating lease or finance lease, the criteria is if the lease transfers significant risks and rewards related to ownership to the lessee, then it will be called a finance lease. Now, just to give you a simple example, say you have decided to take a car on lease, okay, and the car has a useful life of, let us say, 10 years. After 10 years, the car is scrapped. You cannot use it any further. For our example purpose, you enter into a lease transaction to take the car on lease for 10 years. You have got a lessor who is ready to give you the car on lease for 10 years, and you have figured out whatever the payment has to be done. Now, if you look at the significance of the transaction, legally you are not the owner. But if you look at the substance, you are the one who will be using the car for 10 good years. You are the one who is taking care of the maintenance, repairs, everything. Just that you are not the legal owner. But in substance, the underlying thing of the transaction is that you will be considered, or you are as good as the owner of the car. The person who has given it to you on rent is not even bothered other than for the monthly rental payments, right? So such transactions are classified as finance lease. Okay, now whenever we talk about finance lease, there are some indications that a particular lease is a finance lease. For example, you enter into a lease contract, and the contract allows you to take ownership of the lease of the asset, leased asset at the end of the period. So you enter into a lease contract. At the end of the lease contract, the asset becomes yours. Okay. So in such case, it is definitely sure that you will be enjoying the significant risk and rewards related to ownership, and hence it will be called a finance lease. Or there is an option to purchase. Say for example, after 5 years, after the lease gets over, assuming that the lease is for 5 years, if the lease, you get an option to buy the car at, let us say, 50,000. Market value of that car at that point of time will be, let's say, 5 lakhs. So you get an option to buy, which you are likely to exercise. Even in that case, it will be called a finance lease, because you are someone, if you are getting it for 50,000, you'll definitely buy it. Then the other condition is if the lease term covers major part of the life of that particular asset. So if the lease payment, if the lease term, let us say the asset life is 10 years, you take the lease for, let's say, 8 years or 9 years or 7 years. No. So this is not, it's not a defined criteria, but something more than 75% of the life of the asset, if you are, covering with the lease term, and in that case also it will be called a finance lease. Then this concept that present value of future lease payments, is almost equal to the fair value of that particular asset. Now what this means is, there is, we don't have a long time to, otherwise I would have shown you some examples also. What this basically means is, if you discount all the lease payments and other aspects related to lease payments, which we'll be understanding in some time, if you discount all of those and bring it to the present value, it is almost equal to the fair value. Okay, so the transaction is structured in a way that over the life of the lease term, you are actually paying off the cost of that particular asset or fair value of that particular asset. In that case also, it will be called a finance lease. And lastly, if the lessor has created certain specialized assets only for the lessee, such that no other customer can use, even in that case, it will be called a finance lease. So any lease other than finance lease will be classified as operating leases. Now, this distinction is important only from lessor's accounting point of view. This is no longer relevant for lessee's accounting. For lessee, even though or whether it is a finance lease or an operating lease, you will have to do the same accounting treatment, right? So I'll just come back. Yeah. Now we talked about, right, the present value of lease payments. What all are covered in lease payments? First thing, fixed lease payments in the contract. This is nothing but your monthly rental. This is nothing but your monthly rental. So monthly rental or quarterly or yearly rental or yearly fixed payments that you make under the contract are called lease, are a part of lease payments. That's the first thing. Second, variable payments. Now, variable payments means what? There are two kinds of variable payment. One, which is based on a rate or an index. For example, you have defined in the contract that every year the rental will increase by 5%. Or you have defined in the contract that rent will increase by the inflation rate. So let us say when you entered into the contract, inflation is 4%. So you know at the time of entering into the contract that you have to pay 4% extra rent next year. So in such cases, these variable payments are considered as a part of lease payments. Okay, but if something has to be paid based on performance, I think there was a disruption in the network.
I think it's visible right now.
Yeah, there was some disruption in network. I think it's fine now. Am I audible, Sakshi? Yeah, it's fine. Thanks, Ashwini, for the confirmation. Okay, so yeah, we were at this point, variable payments. One is which is based on a rate or an index. The second one is based on performance. Now, what do I mean by performance? Say, for example, you take up a shop on lease in a shopping mall. Okay, there is a mall and you have taken a shop on lease. And the contract requires that apart from the monthly or the quarterly fixed lease payments,
you are also required to pay, let us say, 10% of the sale value to the mall owner. Okay, these are performance based payments. It could be based on sales, it could be based on production, it could be based on any parameter, but it is based on performance. If it is based on performance, then you will exclude it from the lease payments. So when you do that discounting, present value of future lease payments, you will consider fixed lease payments, you will consider variable payments other than performance based payments. Basically, you must be able to identify those payments at the time the contract is entered into. Then we talked about the exercise price or the price of a purchase option. That is, you will be able to buy the car for 50,000, right? That is called the exercise price of a purchase option. So even that will be considered as a part of the lease payment. Then there is another term called residual value guarantee. Now this residual value guarantee is kind of a committed payment, a fixed payment that the lessee will pay at the end of the contract. It may be for taking away some stuff out of the premises, or it could be for, let us say, you have taken a premise on rent, and for 5 years you have used it, there would be some damage, there would be something. For that, at the inception of the contract itself, they have defined something that, okay, we will pay some amount. Let us say we will pay 50,000 at the end of the contract when we vacate the premises. Okay, that is called residual value guarantee. So this residual value guarantee is also a part of the lease payment, both for the lessor as well as the lessee. Now this guarantee can come from two parties. One, the lessee. So if it comes from lessee, it will be included in the lease payment of the lessee as well as the lessor. It can also come from a third party. It can also come from a third party. If it is coming from a third party, then it will be only considered for the lessor and not for the lessee. Now the reason why these components are important is when we do the accounting, we have to compute something. When we have to do the accounting,
Is there a problem, Suraj?
no, I think there's some network connection. So and I'm getting this reconnecting thing out here. I'm continuing. Okay. So the importance of these lease payments is that when we talk about discounting these lease payments, we need to know what are the various components, and we have to compute something called as implicit rate of return. Okay, implicit rate of return means the rate at which the present value of those lease payments from lessor's perspective is equal to the fair value of that particular asset. So if, say for example, let's say that asset is worth 5 lakhs, that is the fair value today, and you make certain lease payments over 5 years period. When you discount all of those lease payments, the rate at which these present value of lease payments are equal to the 5 lakhs, which is the fair value, that is called the implicit rate of return. Just allow me a moment. If I can share the screen, I'll actually work it out and show it to you guys. I think I don't have the sharing permission. Is there any permission needed to share, Sakshi? Okay, so I don't have the. No, I am not on mute. Okay, no worries. So I'll continue with the, presentation here. Okay, so the rate at which, when I discount the lease payments, the rate at which those discounted values are equal to the fair value of that asset, that is called the implicit rate of return. And we will use that implicit rate of return to compute the present value even for the lessee. Now you need to understand one thing. When the lessor computes the present value, he will consider everything, including the third party residual value guarantee. But when the lessee does the computation, he will only consider his own share of guarantees. He will not consider any third party guarantees. So what you do is you discount all the future payments, you calculate the present value, and the rate at which this present these present value, discounted present value is equal to the fair value, that is called implicit rate of return. Okay. Now, as far as lessee is concerned, all the leases will be recognized in the books of the lessee unless it is either a short-term lease or a low-value lease. Short-term lease is less than 1 year. You have a 6-month contract or a 9-month contract. So, there is no need to get into these kind of complications. And low-value leases. Low-value leases means leases which are, of small values which the management can decide. Let us say you take mobile phone on lease. That's also allowed, right? So, such kind of things the management can decide and exclude, okay, from lease accounting. Otherwise, the lessee, whenever it identifies that a contract has a lease, needs to account it by creating a right of use asset. You will not create an asset. It is a right of using an asset, and it will also create a lease liability. And hence, both of these items will be presented in the financial statements. Sorry guys. Okay, so now how do we compute this amount? This right of use asset and lease liability is nothing but the present value. It is the present value of future lease payments. Present value of future lease payments. And the rate which should be used to compute this present value of future lease payments is the interest rate implicit in the lease. Now, what is the interest rate implicit in the lease? That is the rate at which the present value of lease payments and the unguaranteed residual value is equal to the fair value plus the initial cost which the lessor would have incurred. Now, this is the rate which is known to the lessor and it may not be known to the lessee. And if the lessee cannot compute this rate, then they will use something called as the incremental borrowing rate. Now, incremental borrowing rate means today if you have to take a loan, today if you have to make a borrowing, what is the rate that is given to you by your bankers? That is the incremental borrowing rate. First priority, interest rate implicit in the lease. If that is not there or that is not available, you will use incremental borrowing rate. This is the most important thing. There is no distinction in the books of lessee whether it is an operating lease or a finance lease. Okay. Now, when it comes to the income statement, because we have created a lease liability, and we have discounted that using an interest rate, every period we will charge certain interest component or an interest expense to this particular liability. So say for example, the present value is 50,000. Present value comes to 50,000 and the implicit rate of return is 10%. So 50,000 multiplied by 10%, 5,000 will be the interest cost or the finance cost which will be accounted when we do the accounting in the subsequent period. Right? So, for the lessee, you will have a finance cost which is nothing but the rate applied to the lease liability, and we will also have depreciation which we charge on the right to use asset. So, this right of use asset, whatever we have created, we will be depreciating that over a period of time, and on this lease liability, we will be providing interest or we will be providing interest expense every period. And the payment that you make to the lessor, that will be split between the lease liability and the interest cost. So it works like as if you are working on an EMI transaction. There is a principal component and there is an interest component. Okay. Now, the variable lease payments, what we talked about, right? Performance-based lease payments, if they are not included in the liability, initially, then they are recognized in the income statement in the period in which the payment is done. So this is the accounting crux of accounting in the books of lessee. Any doubts so far? If anyone has any doubts, you can let me know. So I'll be happy to address that.
You can do it. It's in the toggle bar near the video section. Uh,
Yeah, I'm trying to share it. It says permission is not
when
available.
I try to share it, it is already showing that you're sharing it. That is why I.
Correct. So now it's saying something else is already being shared. So if I click on yes, share, and it gives me an entire screen option, and then it just says permission is
Oh,
not there.
okay. I just figured this out. Meanwhile, I think you can start with the continue with your presentation. I have
Because I think that will help the students to.
Yeah, let me figure this out. There's generally no problem when people share the screens. I don't know why is there an issue. Just give me 2 minutes. 2 minutes. Uh, and meanwhile, I have a
Just a
question for
second.
you. You were talking about the fact that operational leases are also considered in balance sheets according to the Ind AS right now, right?
Correct.
Because initially, old AS it was not considered. But I had a question whether
Correct.
are there any kind of leases that are kept off balance sheet? Uh,
So those leases would be the short-term leases. That is one thing which are excluded, and where they can choose to keep it out. And the other one would be low-value leases. Okay, then you would actually exclude them from the entire lease
okay.
accounting scope itself. Apart from that, everything would be a part of your balance sheet for the lessee, right? And there is a very interesting question which has come up: will the asset be shown in balance sheet of both lessor and lessee?
I can check, share my screen right now. Can you just try it again? I think it will be great if you could try it again. I
Yeah,
was
just a
able to do
second.
it.
Let me. So I'll just say when I click on share screen, I get this option, and when I share, it says system permission is not there. So when I click on enable system permission, it takes me to a link. Let me just
Yeah,
check if I
because
can get
initially when
something
you
here.
tried,
Okay, okay. I got it. I got it.
you can also address Shreya's question
Thing
also
with,
together, together.
yeah. Just a second. It's something to do with my Mac settings.
Okay, great.
Okay.
Because initially you tried sharing and it showed your screen, so I think it should not be a problem.
So that was my other Mac.
Meanwhile, all you attendees, if you have any more questions, like Shreya's asked a question, and if there are any doubts relating to operational or financial leases, because this is something that has been recently introduced in India. You guys can ask us questions regarding the IRR also, and
Yeah, so IRR, I think if you guys permit, we'll extend
yeah,
it
yeah,
by a few
definitely.
minutes, and I'll actually want to
Sure,
solve
sure.
it on the screen. Only then, it will be helpful for the attendees. Otherwise, just a theoretical
Great,
presentation would
great.
not make
No
sense.
problem with the timeline as long as all the people are interested in the topic and they're ready to wait. We don't have a problem with that at all. If you can share the screen and teach them how it's computed, the
Yeah, I think I got it. My Mac had restrictions on.
yeah. Hi guys. So sorry for the delay. I think we will just change the laptop. In a few minutes, I think he'll be back and he'll be able to help you understand how Implicit is calculated and he'll be able to understand the whole concept in a better way. Were you able to resolve this problem? Yeah, yeah, we can. We
Yeah,
can.
so are you able to see my screen? Okay, so I think the most important thing which all of us need to understand is the
Yeah, yeah, we
can you
can.
see the Excel screen? Yeah. Okay. So now the most important thing that we need to understand is that concept around the present value. Okay. So let us say, let's take a very simple case that okay, there is a lease transaction, and at the end of every year, okay, so end of every year, or I'll just denote it as year. Let me put at 1, 2, 3, 4, 5 years. Okay, so there is a lease transaction. Consider there is an asset which is being leased, and there is a lease transaction where at the end of every year you have to pay certain amount. Let us say that the lease that is to be paid is 1 lakh. Okay, every year 1 lakh has to be paid. Now there could be other items also, right? At the end of the year, at the end of the 5th year, there may be a residual value guarantee that needs to be paid. We'll keep that aside for now, just to understand the implicit rate of return and how does it work in terms of accounting. So there is a lease payment 1 lakh every year at the end of every period. Now what we need to do is we need to discount this and get to the present value. We need to compute the present value of these lease payments. Okay, and let us assume for our discussion that the fair value of of asset today is 4 lakhs for simplicity sake. Okay, now let me discount this using a particular rate. Let me discount this using a rate of 10%. Okay. So when I discount it using the rate of 10%, I can use this formula all of us must be aware of. Present value is future value divided by 1 plus rate of return, that is the rate, to the power of number of years, right? This gives me the present value factor. 1 divided by whatever is the rate of percentage. I can do it for year 2, year 3, year 4, year 5. I can compute all of these, and with this I can compute the present value of lease payments, that is 1 lakh multiplied by this 90,000. I copy the formula, and if I sum this up, I get a present value of 3,79,078. Okay, so if you see at 10%, the present value is 379,078. I can do some trial and error, and if I do 11%, it reduces further. So I need to reduce the rate. If I make it 9%, it is 388. If I to get the exact number, what I can do is I can use this option called goal C. So I can just put a goal C. So set value, this particular cell, set value to let us say 4 lakhs by changing cell this and hit OK. So it has computed and given me 8%. If I increase the decimal,
That should be around 7 point.
it is 7.931. Okay, 7.931. Right? So at 7.931 percentage, the present value of all this future payment is equal to 4 lakhs. This we also refer to it as IRR. Okay. So if you want to compute using IRR method, you can simply write minus 400,000, that is the asset which is going out, and you have 1 lakh every year, 5 years. So you can have IRR for these values. It again gives us the number which is 7.931. So this is the way you can use Excel. You can do a trial and error method. Now what does this 7.931% indicate? How does it play out? So now the present value of future lease payments is 4 lakh. This will be my ROU asset 4 lakhs, debit, credit, lease liability 4 lakhs. ROU asset 4 lakhs, lease liability 4 lakhs. And if I prepare a lease schedule, which is year, opening balance, interest, payment, and closing balance. So you have 5 years. Okay, opening balance would be 4 lakhs. Interest at the rate of 7.931 percentage. You will make a payment of 1 lakh. Closing balance will be opening balance plus interest minus payment. Okay, and then next year opening balance would be 3,31,723. Add interest, payment, closing balance will be so much. Like this, you can continue for 5 years, and you see at the end, at the last year, it becomes 0. Now, what is this? The annual lease payment which the lessee is making is towards interest and towards principal, that is payment minus interest. So 31,000 is payment towards interest, 68,000 is payment towards principal. Similarly, every year we can find this segregation that some part is towards interest, some part is towards principal, and at the end of the 5th year, total interest that we have paid will be 1 lakh, and total principal that is repaid is 4 lakh. When you make the repayment, let us say you are repaying it at the end of year 1. Okay, at the end of year 1, what are you doing is you are paying an interest cost or interest expense of 31,000. Then you are making the lease liability payment which you debit of 68,000. These two are debits. Credit, bank, 1 lakh. So like this, every year when you pass the entry, this lease liability you would have credited by 4 lakhs and it would be 0, and the total of interest that you would pay would be 1 lakh. And apart from this, you will also depreciate. So let us assume that the life of the asset for you is 5 years because you are not using it beyond 5 years. Every year you will have depreciation, that is 4 lakh divided by 5, and credit ROU asset 80,000. And like this, every year you will depreciate the ROU asset, and at the end of the 5th year it will become 0. So this is something which I wanted to showcase it to you when we talk about leases. Now, not only this, even if let us say the implicit rate of return for operating lease is also computed, and for that also you will pass similar entries. Now, how will we compute implicit rate of return in case of operating leases? See, at the end of the 5th year, right, there will be some residual value which will come back to the lessor. So that will also be considered to compute the implicit rate of return. Right. So I hope you have understood the accounting aspect of.
Okay. Suraj, Vartika had a question. She wanted to understand how you calculated 7.931%. If you could show.
So that was using the goal seek option. Okay, I'll just show it to you again. There are two ways to calculate. One was using the goal seek option. So what I did was initially let me put 8%, and this was not coming to 4 lakhs. So these are all formula driven. So there is an option called data, what if analysis, goal seek. So here what I can tell Excel is in D7, set the value as 4 lakhs by changing this rate of interest and click OK. You will get 7.931.
Your answer is solved here.
Okay.
Okay. Yeah. Okay. So there.
Or otherwise, what you can do is you can just list down minus 4 lakhs and list down this, and you can calculate the IRR. That can be done. That would help you. Okay. Then there is a lease contract towards equipment hire, 5 numbers for a period of 5 years. In the 3rd year, 1 equipment is dehired. So now when you here, if you have hired 5, yeah, sale and leaseback, I'll be coming to it again. If you have hired 5 equipments and 1 equipment has been dehired, you may have to treat it as a new contract and termination of the earlier contract. Okay, so I'm not actually getting into the very much depth of Ind AS here because the time is pretty much restricted. So you will have to see whether you need to segregate those contracts, terminate the original contract, and re-evaluate it as a fresh contract. Now,
there's another question.
This part, interest expenses will go to the P&L, lease liability will impact the balance sheet, depreciation will go to P&L, this will impact the balance sheet. Okay. Now,
Suraj, there are two more questions. One is from Shreya. Shreya is asking, will the asset be shown in balance sheets of both lessor and lessee?
So now, in case if it is an operating lease, now we are not. Now, please note, in earlier cases we used to show asset. Now the term is, it's not P anymore. We are using the term right of use asset. We are not saying asset. We are saying right of use asset in the financial statements of the lessee. So the lessor, in case of operating lease, may continue to show the asset. Lessee will continue to show right of use asset. Now, when it comes to lessor accounting, in case of operating lease, he will continue to recognize the asset. Okay, he will continue to charge depreciation. This is lessor. There will be no selling profit which will be recognized. This we have covered. Finance lease we have covered. Now, okay, one more thing. If it is a finance lease, in case of lessor, what will happen is lessor will de-recognize the asset, because we are saying significant risk and rewards of ownership are being transferred. The lessor will de-recognize the asset in its books, and he will account for it as a lease receivable. He will account for it as a lease receivable and de-recognize that asset in the books. For example, in this case, what will the lessor do is, let us say, you have sold this is the particular asset. Okay, now lessor will compute two things: gross investment in lease, right? This gross investment in lease is sum of all lease payments. So in our case, sum of all lease payments is 5 lakhs, right? Then we'll compute net investment in lease. This is the present value, which in our case is 4 lakhs. Okay, this also is the fair value, right? Then the difference between these two is the unearned finance income, which is 1 lakh. Assume book value of asset is rupees 3,50,000. For whatever reason, they are not marked it to fair value. It is 3,50,000. Now, when the lessor does the accounting, the first thing they will do is they will de-recognize the asset. They will de-recognize the asset, then account for any gain or loss. So the entry would be, you will de-recognize the asset. So you will credit asset from the books at the book value, which is 3,50,000. Then you will account for lease receivable, which is your net investment in lease. Okay, then you will account for gain or loss, which is 50,000 in this case. So lease receivable is 4 lakhs, 3,50,000 is the receivable thing. You will account for it as gain or loss, right? That is one approach. Other approach would be to account for lease receivable at gross value and also show the unearned finance income and credit it to the respective asset account. So what are you doing here is, you are de-recognizing the asset and also accounting for the gain or loss. You are accounting for the gain or loss on this transaction. So lessor will no longer provide for depreciation if it is a finance lease. But
so now we have understood the accounting aspect in the books of lessee as well as in the books of lessor. As far as lessee is concerned, now there is no distinction between an operating lease and a finance lease. All the leases have to be brought onto the balance sheet. As far as the lessors are concerned, if it is a finance lease, they will de-recognize that asset
and book any gain or loss out of the transaction. And if it is an operating lease, then they will continue to recognize the asset in their books, and they will recognize the income coming out of the lease generally on a straight line basis. Straight line basis means you will sum up all the lease payments and divide it by the number of periods, and the lessor will continue to charge depreciation. And obviously, because there is no a transfer of risk and rewards, there is no selling profit, right? Now moving on to the next aspect, which is one of the most important ways to structure transaction: sale and lease back. Now these are used when we have owners of asset who need money, but they don't want to take any loan, and they may want to sell that asset, but they want to continue to use the same asset. For example, I have a machinery, I am in need of fund, I can sell my machinery and get money, but I also want to continue to use that particular machinery. So what I do is I find a buyer to whom I can sell my property, right? So my property goes to the buyer, and I again take it back on lease from the buyer. So there is an owner sells the property to a buyer. Now buyer becomes the lessor and the owner becomes the lessee. Means when I say owner, it is the the previous owner. The previous owner becomes a lessee. So there are two transactions combined as a package. One, sale; second, lease back. So you sell that asset and you take it back on lease. Now these kind of transactions are structured to ensure that you get money immediately when you sell that particular asset, and you also have the flexibility to use that asset over the life of the asset. Now earlier what used to happen is you used to sell and take it back on some lease. Let's say you take it back on operating lease, then there was no need to recognize that particular asset in your books. There was no need to bring out any liability in your books, and you could make your balance sheet lighter. But with the new standard coming into place, even if it is an operating lease back, you will have to account for it as a lease and bring it back into the books, right? So how do you decide, or how do you do the accounting? First, you have to see whether control has been transferred as per Ind AS 115, that is your revenue standard. Have you transferred the control to the buyer? So did this owner, the previous owner, transfer the control to the buyer? So that is one thing that you need to ask yourself. If the control has been transferred, then you can recognize it as a sale. And then the lease back transaction is accounted as a separate lease transaction. So one part you will account for it as a sale, and the next part you will account for it as a lease back. But let us say control has not been transferred. Now what do I mean by control has not been transferred? Maybe the transaction is structured in a way that the previous owner still has retained some rights of ownership with him, or the previous owner may repurchase it back at a later point in time. Okay, so if these kind of structures are built into the transaction where control is not given up, the effective control on the asset is not given up, the original owner retains the control of that particular asset. Maybe they have entered into a transaction where this earlier owner continues to use it forever, kind of a thing, where effective control is not transferred. In that case, we consider that there has actually not been any sale, and it is actually a failed sale transaction, and we will consider it as a financing transaction and take it within the purview of Ind AS 109 and recognize it as a liability and an asset as per the principles given in Ind AS 109. Okay, so this is about sale and lease back in a gist. Now sometimes what happens is these sale and lease back transactions don't happen at the market value. Now what I mean by it doesn't happen at the market value is that, let us say this owner has sold this asset to the buyer, but the price at which the owner has sold this particular asset is less than the market value, and they have taken it on lease back. So there is a sale is happening at less than market value, and then again there is a lease back followed immediately after the sale. Now in such a situation, you need to see what is the extent of, or whether it is sale. So in that case, what you need to see is whether sale has happened at less than market value or sale has happened at more than market value. Now, in this case, let us say the owner has sold that particular asset to the buyer at a lesser price. At a lesser price means what? If it is an asset, let us say worth 1 lakh, but the sale has happened only at 80,000, means the buyer has given lesser amount to the owner. Or if you just add one more angle to this, buyer was supposed to pay 1 lakh, buyer paid only 80,000. You can also look at it as if owner prepaid 20,000 to the buyer. If the buyer would have paid 1 lakh, owner would have paid 20,000. So the net receipt to the owner would have been 80,000, right? So if amount received is less, we treat as if there is a prepayment of leases. There is a prepayment of leases. If amount paid is more, we will treat it as additional financing. Correct. So you have to see whether the owner has paid a higher, buyer has paid a lesser value or a higher value. If buyer has said, say, instead of paying 1 lakh, buyer has paid to the owner 1,20,000, that extra 20,000 is treated as an additional financing, as if the buyer has provided some additional financing to the owner. Okay. Similarly, if the lease payments are less than market value, then again you will have to see whether it, that you will have to make an adjustment accordingly. If lease payments are more than market value, again you have to make the payments, again you have to adjust the payments accordingly. It could be a prepayment of lease or it could be an additional financing. So this is how sale and lease back transactions are structured. Now, it's unfair on my part to say that I have covered everything in this 1.5 hour session, because lease accounting is a vast standard. There are write-ups which run into 800, 900 pages just to explain the various nitty-gritties of lease transactions. But this is what I could cover the best in the given session, and I hope it has been helpful to you guys. Right. So if there are any more questions, I am happy to take that, and then we can call the session to end.
Okay. Thank you, Suraj. Thank you for such an amazing session. There are a couple of questions that I would want you to answer. The attendees are asking. So the first question is, I want to know about the change in accounting before and after leasing on P&L and balance sheet for both lessor and lessee.
Okay. So now if we compare this with the earlier Ind AS that was in existence, and with the with the new Ind AS that has come into the picture, the major change has happened on the lessee side. So earlier, lessee would show operating leases off the balance sheet, but now operating leases are also brought onto the balance sheet on the lessee side as far as the lessee is concerned. So for lessee, the distinction between the operating lease and finance lease is gone. All the assets, all the leases are brought onto the balance sheet. They are shown in the balance sheet. Now, what will this result in is, this will make the balance sheet of the lessees heavier. Heavier meaning you will have to show more assets in the books of accounts. Any more questions?
Yeah. So the next question is, what is the CLM method?
So actually, it's not CLM, it is SLM method, straight line method. Straight line method is what we call. Let me just open. Let me just explain it to you. How does that work? So that so when we say straight line method, let us assume that there are 3 periods. 1, 2, and 3. Okay, and the lease payments are, let us say, 15,000, 20,000, and 22,000. For some reason, this is how it is structured. Okay, now generally we would assume that the lease income should be accounted as 15,000, 20,000, and 22,000. It doesn't work that way. We have to calculate what is the total of these lease payments. That comes to 57,000. Number of years, 3. Annual lease
income would be 57,000 divided by 3, that is 19,000. So every year the lessor would account for a lease income of 19,000. Now the immediate doubt which can come to our mind is, when lease payment itself is 15,000, how can we account for it as 19,000? So how it works is, year 1 you would receive money 15,000, and you would say lease income $19,000, and the balance you will take it to some equalization reserve. We call it lease equalization reserve, that is 4,000. This is year 1. In year 2, what would happen is, you would receive a lease rental of 20,000. Your lease income will still be 19,000. So you will reverse lease equalization reserve to the extent of 1,000. And in year 3, you would receive 22,000, right? And balance 3,000 would go to lease equalization reserve. So you create a fresh item called lease equalization reserve 4,000, reverse it when you in the future periods, right? So this is how we call it straight line method of accounting. 19,000 is accounted as income each year. Now, if SLM method is not appropriate, or if there are any better ways to represent this lease income accounting, we can follow that particular method.
Okay, thank you so much, Suraj. There's another question that has come up. So Shreya is asking, will the asset be shown in balance sheet of both lessor and lessee?
Yeah, so in this case, like for example, if it is an operating lease, right, what would happen is, the lessor will not de-recognize the asset, and the lessee will show something called as ROU asset. So we need to understand that it is now called as ROU asset, that is right of use asset. So lessee would show like right of use asset, lessor would continue to show the asset in his book. This is in case of operating lease. If it is a finance lease, lessee will show ROU asset, whereas lessor will de-recognize the asset and show lease receivable. So we are not showing same asset in both the books. One party shows an asset, the other party is showing right to use that particular asset.
Okay, okay. Thank you so much. I think these are the only questions that were there. It has been a great session. Thank you so much, Suraj.
Thanks a lot, Sakshi, for the opportunity.
You're welcome.
Yeah.